In the world of finance and investment, few names resonate as distinctly as Robert Kiyosaki. Renowned for his groundbreaking book, Rich Dad, Poor Dad, Kiyosaki has shaped the way millions think about money, assets, and investing. But there's an intriguing aspect to his investment strategy that often sparks curiosity. His reluctance to invest in the stock market. This isn't a decision made lightly, nor is it without profound reasoning. Today, we're delving into the mind of Kiyosaki, peeling back the layers of his financial philosophy to uncover the 7 core reasons behind his avoidance of the stock market. From his views on market volatility to his unique investment preferences, we're set to explore why this financial maestro chooses paths less trodden in the world of investment. 1. Market volatility. In the realm of stocks, unpredictability is king, and this forms the crux of Kiyosaki's first reservation: market volatility. For someone who spent a lifetime studying and mastering the art of financial stability, the roller coaster nature of stock prices is a red flag. Kiyosaki often points out how swiftly market sentiments can shift, turning investment gains into losses in the blink of an eye. He argues that this inherent instability is a gamble, one that doesn't align with his principles of investment certainty and control. In his view, the stock market's unpredictable swings are not just about the highs and lows, they're about the inability to predict or control these changes, making it a risky terrain for those seeking long-term investment security. 2. Preference for real assets. Moving to his second reason, we find Kiyosaki's strong preference for tangible assets like real estate. Unlike stocks, properties are assets you can see, touch, and improve upon. For Kiyosaki, this tangibility isn't just a matter of preference. It's a cornerstone of his investment strategy. He believes in the power of real assets to generate income, appreciate in value, and provide a measure of control that stocks simply cannot match. Real estate investments, in his eyes, offer a more direct influence on the asset's value and performance. Kiyosaki often emphasizes the long-term value and stability that come from investing in physical properties, seeing them as a more reliable path to wealth creation than the often speculative nature of stock investments. 3. Concerns about market manipulation. Kiyosaki's third centers around his concerns regarding market manipulation. He often speaks about the opaque nature of the stock market, where large players and institutions can have disproportionate influence. Kiyosaki highlights how this can lead to scenarios where smaller investors are at a disadvantage, unable to access the same information or wield the same influence as larger entities. This, in his view, creates an uneven playing field where the risks of manipulation and insider activities can adversely impact the average investor. Kiyosaki argues that such potential for behind-the-scenes maneuvering in the stock market further exacerbates its unpredictability, making it a less attractive option for those seeking transparent and fair investment opportunities. 4. Inflation and value dilution. The fourth dives into Kiyosaki's perspective on inflation and its impact on stock values. He often discusses how inflation can erode the real value of monetary investments, including stocks. Kiyosaki points out that while stocks might appear to increase in value, this rise is often offset by the decreasing purchasing power of money, leading to what he refers to as value dilution. He stresses the importance of understanding the difference between nominal gains, in terms of currency, and real gains, in terms of purchasing power. This insight leads Kiyosaki to favor investments that he believes are more resistant to inflation, like real estate or commodities, which can potentially offer more stable and tangible value growth over time, unlike the more inflation-vulnerable stock investments. 5. Lack of financial education. Kiyosaki's fifth for steering clear of the stock market is a fundamental one: the lack of financial education among most investors. He often speaks about the complexity of the stock market and how it requires a deep understanding of financial systems, market trends, and economic indicators. Kiyosaki believes that without this specialized knowledge, the average investor is navigating in the dark, vulnerable to making uninformed decisions. He emphasizes the importance of financial literacy, arguing that many individuals invest in stocks without fully grasping the risks and mechanics involved. This gap in understanding, according to Kiyosaki, can lead to poor investment choices and unnecessary losses. His approach advocates for investing in areas where one has expertise or can gain comprehensive knowledge, thereby reducing risk and increasing the likelihood of successful investment outcomes. 6. Better alternatives. The sixth takes us to Kiyosaki's belief in better investment alternatives to the stock market. He isn't just about avoiding stocks, he's about seeking opportunities where he sees greater potential. Kiyosaki often points to real estate, business ventures, and intellectual property as avenues offering more control, stability, and opportunity for growth. He views these types of investments as not only avenues for income generation, but also as platforms for learning and personal development. For Kiyosaki, the value of an investment isn't solely in its financial return, but also in the skills and experiences it brings. He advocates for investments that align with personal strengths in areas where one can actively contribute to the growth and success of the endeavor, rather than passive stock market investments where the investor's role is limited and often reactive. 7. Personal investment philosophy. The seventh and final is perhaps the most intrinsic to Kiyosaki's approach, his personal investment philosophy. This philosophy is rooted in the pursuit of long-term wealth building, not just short-term gains. Kiyosaki often talks about the importance of creating assets that provide lasting value and generate continuous income. He sees the stock market as a field dominated by speculative gains and short-term thinking, which doesn't align with his vision of financial freedom and wealth accumulation. Instead, Kiyosaki advocates for investments that align with personal values, contribute to one's financial education, and offer a sustainable path to wealth. This could mean investing in businesses, real estate, or other areas where the investor plays an active role in growing and managing the investment. For Kiyosaki, it's about building a legacy of wealth that extends beyond mere monetary gain. Counterpoints. In this part of the video, we addresses some common counterarguments in favor of stock market investment. It acknowledges the success stories and potential benefits of investing in stocks, such as liquidity, diversity, and the opportunity for significant returns. The script also touches on how the stock market can be a viable option for those who have the requisite knowledge and risk appetite. This balanced view ensures that the audience understands that while Kiyosaki may have his reasons for avoiding the stock market, it remains a legitimate and potentially lucrative investment avenue for many. As we wrap up our exploration into Robert Kiyosaki's reasons for steering clear of the stock market, it's clear that his approach is deeply rooted in his personal philosophy and understanding of financial investment. From concerns about market volatility and manipulation to a strong belief in the value of financial education and tangible assets, Kiyosaki's stance is a reminder of the diverse strategies that exist in the world of investment. Now, as you reflect on these insights and how they might influence your own investment journey, remember to engage with us further. If you found value in this discussion, please like, share, and subscribe to our channel for more enlightening content.